Hey everyone, welcome back to the channel. Today we're going to take a look at Shopify. We're going to calculate their WACC. I picked Shopify to look at because they are actually a Canadian-based company and they are listed on the market as an ADR, so an American Depository Receipt. So this is what companies will do, foreign companies, if they want to trade on US exchanges, so on the NASDAQ or the New York Stock Exchange. Basically, like a handful of their shares are kind of like just moved over to a US-based market and they trade on the market. And the companies still have to submit the same, well, similar filings, not exactly the same filings as a US-based company. And I'll go through that today as we kind of talk through how to calculate their WACC here and kind of just like look at, what the difference is, I guess, between a traditional 10K and then for a Canadian company, it's a 40F. So first thing, if you're not familiar with WACC, weighted average cost of capital, formula here in cell C8, you could follow the formula, but basically it's just taking the proportion of equity to the total capitalization and then the proportion of debt and the cost of those two pieces. And then you get a little bit of a tax shield from the debt aspect, just from interest being tax deductible. And then from there, you can get a weighted average cost of capital. But the cost of equity is always the tough part to get, and that's really, we use CAPM here, just the base model. We use the treasury yield as the risk-free. Expected market return is just kind of the expected return of the S&P. So basically the average return of the S&P over the last, I think, 50 years or so. And I have some links here for where I pull these. But so for the treasury, this is a question I get asked. I do the 30-year, and I just looked at the most recent sale. It's 2.25%. That's what's here. 8%, there's an Investopedia article. Feel free to read that. Beta, I'll show you how we calculate that, so that'll be pretty important. Market cap of equity. This is really just their market cap, so 138 billion. I keep my numbers in millions in here. So this is like 138, 743 million, or 1,000 million. So basically add 6 zeros. Anyways, market value of debt. So this is a fun one. If you've never looked at an ADR before, their filings are very similar. So you go to sec.gov, search, type in shop, and you see like 6K supplement 40F. So this is their annual filing. If you click on it, normally you can just click on the first link for like a 10Q. On this one, it's really just, there's not much in here. You have to actually click on the exhibits below. So if you click on this next one, this is more of like the long form, similar to the 10Q, but it actually doesn't have the financial statements. It just has kind of a lot more about the business and the risk factors and the MD&A. So the second exhibit here, this actually does have the financial statements. And so if you go to a foreign ADR company, you'll just have to click through the links within the 40F filing. And I think 20F might be for companies from Europe or China. There's like a 40F and a 20F. You can always just Google it. Something will come up. But so here's financial statements. If we actually scroll down, I've noted the pages here, but page 32 and page 30, they actually have the debt schedules broken out. And the interesting thing about their debt is it's super cheap, which is great, but it's convertible, which could not be great. So in September, right, they issued $920 million, 0.125% convertible notes. So what that means is if they hit a certain price, if the stock hits a certain price, then every $1,000 of this offering could basically be converted into stock. So you could dilute the shareholders by, basically about $1 billion. So, I mean, realistically, that's not that big here. That's less than 1% of what would be the total outstanding equity value, especially because the conversion price is 1,400. Right now they trade at, 1,100, so they'd still have to appreciate another 25% or so. So, they'd be a 1.5 your $150 billion company, something like that. So really wouldn't be too dilutive, but very attractive interest rate. And then they actually have a schedule here on 32 that just shows the amount of outstanding debt. So I took the 758 and the 158. So that's 917. Cost of debt is that 0.125%. So pretty easy to get. Cost of equity, this is the fun part. We just calculate beta. So if you're not familiar with beta, it's kind of like the sensitivity of the stock in comparison to the broader market. So like if the S&P, so right here, right, we calculate their beta 1.37, and I'll show you where we get the data. This is kind of saying like if the S&P moves 1%, we would expect Shopify to move 1.37%. So it's just, it's sensitivity to the overall market. And to calculate it, the best way is usually to do like a 5 to 7 year monthly. And I'll show you here. And you can see here, so they calculate the 5-year beta at 1.44% or 1.44. Our number, right, if we look, is 1.37, so we are a little bit off. And I don't know what they're using to compare it to. If they're using the total market, they could be using like a different. So I use SPY as the ETF. I just, the S&P 500, but you could really compare it to any kind of index per se. So you could do like a VTSAX or something like a total market. They could be doing something like that. Something that includes a little bit more international exposure that the S&P doesn't have, and maybe in that instance Shopify moves a little bit more when you kind of throw in some other things, but S&P is basically just as close enough of a proxy. But to get this, we just need the closing price for every week for the last 5 years, and Yahoo Finance is actually great for this. You just hit historical data, and then you come here, go 5-year, switch this to monthly, hit apply, and then you'd hit download, and when you download, you'll just copy over the adjusted close column, paste it in here, and I always paste the dates over, and then this percentage, it's just, this divided by the prior period minus 1. And actually, let me see, I think I may actually need to extend this formula one cell. There we go. So we'll do that, and same thing will go for here. Oh, that's weird. It doesn't look like that last week of data is actually data. So, interesting. It doesn't look like it actually updated. I'll just actually remove that. But that'll give us our beta, right? So 1.37, and then we'll use CAPM. So what that really is it's the risk-free rate plus beta times the expected return on the market less the risk-free rate. So that's kind of like the market premium. So here that's 5.7%. So 5.7 times 1.37, and then add back the 2.3. We would expect 10.1% return on Shopify. And that's based off CAPM, capital asset pricing model. There's some flaws to it for sure. And there's been some more work done by Fama and French. If you want to go in kind of like the academic world, there's like a 5-factor model that, kind of neutralizes out a bunch of other factors and all sorts of crazy stuff. But I mean, for us, this is a perfectly good proxy for the cost of equity. And from there, you get a WACC of 10.1%. So it really is just the same as cost of equity because they have so little debt in comparison to their equity, and their debt is just so cheap. Like it doesn't actually skew their weighted average cost of capital. I would argue, right, they're probably operating in an inefficient structure. They could probably issue a lot more debt and really lever themselves up if they can keep, a super low rate there. But just a quick video and, calculating the WACC. And later this week, I'm going to have a valuation video and kind of going through the 40F filing of theirs to kind of, show you what to look for if you're trying to do a foreign company valuation. So hope you found this useful, and thanks for tuning in.